Millions of Americans feel stuck. They feel trapped. They're equity rich, but they're strapped for cash. In this episode, I'm going to show you why so many people that purchased homes 4, 5, 10, 12, 15 years ago now feel stuck in their own homes. But most importantly, I'm going to share with you a strategy that a lot of them are doing, a strategic plan that gets you out of debt, but yet maintains your same lifestyle. Now, if you haven't already done so, you may want to subscribe to my channel. My name is Wayne Turner. For nearly 30 years, I've done just about everything when it comes to real estate. I've bought, flipped, sold, helped thousands of people purchase and sell their homes. And I only share that with you so you can have the confidence knowing that what you learn from me is from actual real life experience. This isn't no AI stuff, and I certainly am not reading this from a book. This is hands-on, boots on the ground experience. Let's jump in. So how did we get here? How is it that millions of people that own homes feel stuck in their homes? For one, you have to understand that for 13 years, from 2009 to 2022, mortgage interest rates never went over 5.25%. For 13 years, interest rates never went over 5.25%. You got people that were 13, 14, 15 years old, now they're buying their first house. They don't know life before 5.25%. It didn't really register. But you have to understand, when people bought homes at 5.25%, now you have 67% of the people that actually have a mortgage on their home have less than a 5.25% rate. And how that has helped them gain equity, because the lower your interest rate is, the more you pay down towards your principal balance. And the more you pay down towards your principal balance, the equity that you gain. But that low interest rate has done one thing, and one thing that's great if you own a home, but it's horrible if you don't own a home. And that thing is raised prices. Homes are high. Homes are more expensive. Why? Because that same home that would cost you $2,800 a month if you bought it for $400,000 is now $3,800 a month. That's right. You're paying $1,000, $1,500, $1,800 more dollars a month on your mortgage simply because the interest rates doubled. But a crazy thing happened. You have to know this. In 2022, April 2022, they began raising interest rates, and those interest rates kept ticking up until October, 7 months later. Literally from October to April, 7 months. From April till October, 7 months. Mortgage interest rates doubled. What did that do? That meant every single mortgage payment hit the roof. Now, I don't mean old mortgage payments, I mean new mortgage payments. And what that done is that absolutely froze the housing market. And you have to understand, it's not just real estate agents. It's mortgage brokers, it's lenders, it's anybody and everything to do with any kind of loaning money. Bankers, banks, any home inspectors, contractors, you name it. It put the brakes on the housing market. A little statistic that you need to hang on to, and you might want to write a lot of this stuff down because it's very informative. In 2024, mortgage interest rates were at an all-time high, right? 6.5% to 7%. It's also important to know that in 2024 was the lowest year for home sales in 29 years, not since 1995. But why is that? Why did they leave the rates so low for so long, and why did they all of a sudden want to increase the rates? It leaves you stopping and scratching your head. Maybe you've got your opinion. I know I have mine. But for the life of me, it doesn't make any sense. It doesn't make any sense to me why you would keep mortgage interest rates so low. The money was cheap. The money was really cheap for 13 years, and then all of a sudden you doubled the money. Why is that? I really don't, for the life of me, other than the banks run the country. But that leads me to a question. Would you trade in your 4% interest rate for a 6.5% interest rate? Most people would say not. You're welcome to leave your comment, but most people say, no, there's no way I'm doing that. However, that's where the golden handcuffs come in. You see, people that own homes and have a mortgage, they also have car notes, they have student loans, they have medical bills, and most importantly, they have credit card debt. As a matter of fact, the average household in this country has $33,000 in credit card debt. That's the average amount of money that the average household in the United States owes in credit card debt. You heard me correctly, $33,000, the highest in history. Now, if you own a home and maybe you're in that position, or if you can imagine owning a home and you have car notes, student loans, credit card debts, you're probably in the position of going back to where I said people are stuck. They feel trapped. They have a low mortgage rate, right? But they can't move because if they sell their house, they're going to lose this rate. However, they're paying lots of bills, lots of payments, car payments, truck notes, RV, motorhome, you name it. They have that in addition to their mortgage payment. However, people are making a change. The reason for this change is people have realized that they are rich on paper, but just a little cash strapped. A lot of people don't have the $5,000, Lord forbid there be an emergency, but they have $100,000+ equity in their home. A lot of you, and you may be one watching, that you bought your home before 2022. You've paid down your principal balance because you had a lower interest rate and home prices have gone up. As a result, you have an unforeseen amount of equity in your home. Now, there is a way to access that equity in your home, but you have to understand that's going to put you in a second mortgage or a home equity line of credit, and it's going to prolong the time that you live in the home. There is a way, though, that you can make a change. It's called selling smart and buying smarter. You see, most people don't know this, but they can sell their home, pay off all their debts, move into another home, and even have cash left over, not be broke, not be strapped for those payments. And here's how they do it. They get approved for a loan with their current income, less what they're paying in debt, credit card debt. Let's say you have $40,000 on a vehicle and you owe $30,000 in credit cards, but you have $100,000 equity in the home. You get with the lender and say, hey, I want to be approved. My home's worth $100,000 in equity. Once I sell it, I'm going to have cash in my hand. I want to pay off this debt. So they're going to look at your income. Now, keep in mind, you may move up to a larger home and that interest rate may not be as what it used to be. You may not have a 4% rate, but you have to understand, if you're paying 8-9% on a vehicle and 22% in credit card payments, this right here will get that stress off your mind if you feel trapped or strapped in your current home and you're looking to move to maybe a home with a pool, a home with a bigger yard, you need more square footage, a neighborhood that you want to live in that's in a better school district. Bottom line is you just get approved with the basis of the credit and the debt not there. So you're paying off the debt, and you do this at closing. It's a lateral move. You put your home on the market, you go find another home. You move from your home and you close on the sale of your home and the purchase of your home the same day. I've been doing this for 30 years. And that equity at the closing attorney's office, they pay off any and all your debts and they give you a check for whatever's left over. Or you tell the lender, hey, I'm going to put down 5%, or I want a 100% FHA loan, or I want to do 3.5%. Bottom line, there's people that make this move transitionally from one house to the next. You're not doing a double move. You move from your house to the new house. The debt's being paid off. The debt's being paid down. So you can see how when I ask, would you trade your 4% for 6.5% rate? And most people would say, no, not at all. But you have to understand, if you're paying 22-25% in credit card debt and you owe $30,000-$40,000 in credit cards, student loan, medical bills, car payments, whatever it may be, that causes stress and pressure. And so you can kind of get that wiped out, turn the page, if you will, move on to a new chapter in life, and still have equity in your hand. I'm Wayne Turner. I hope you enjoyed this video. If so, subscribe to the channel. Give us a thumbs up if you like it. Leave a comment, ask questions. We'll do our best to get to every single answer for you. Until next time, thank you and God bless.